Hello, everyone. Today on the final bar, my guest is David Auerbach from World Equity Group and also the Daily REIT Beat. We're going to talk about real estate in particular. It's a sector that not everyone is able to focus on all the time. It's some interesting opportunities, tend to be revenue generating, dividend producing opportunities. So we'll see how that fits into our overall sector view. Overall, the S&P coming off and some distribution going into the close for all the major averages. The S&P closing down about 0.5%. What does that mean for the big picture? Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we work together to make sense of these markets using charts, focusing on the message of the markets themselves, identifying trends, understanding momentum, and leaning into what's working, leaning away from what's not working. You know, when you look at the S&P over the last 2 days, you've certainly seen some distribution going into the close. Yesterday, you had a nice rally until the last half hour. We had kind of a similar configuration to what we saw today, sort of some choppiness and weakness going into the close. But overall, the S&P not far away from all-time highs around 4,000. So how bad are things? They're not bad if you look at the long-term trend. It's all about the messages that we can tease out in the short term, looking for rotations, looking for distributions, and we'll try to identify some of the patterns on all the charts we can. As I mentioned, we've got a great guest today, David Auerbach, coming back on the show today, focusing on real estate. Next week on the 31st, we have JC O'Hara. Oh, sorry, this is actually tomorrow, Wednesday, the 31st. Sorry, JC O'Hara from MKM Partners. On Thursday, the 1st, Matt Tuttle from Tuttle Tactical. We'll take the day off on Thursday from the market holiday. I'll be out all of next week. And just as a reminder, we're going to have guest hosts on this show for the whole next week, the week of April 5th. People like Aaron Swenlin, our own Grayson Rose, Greg Schnell, others have all agreed to take a day and debrief on the markets with you. Should give you a couple different perspectives on how they wrap the day, and hopefully it's time well spent for you. And I'll be back with you on April 12th. Let's get to our market recap. I did want to start with a poll. We asked you sort of a technical analysis quiz this time. During a downtrend, you see a small real body, meaning the open and close are very close. No upper shadow, meaning there's very little above the open and close, and a long lower shadow. What candle pattern is this? 71% of you correctly said it's a hammer candle, and that is exactly what it looks like, right? We always talked when we were learning this, think of it as hammering out the bottom. You have a downtrend, you have what looks like a hammer, right? The head of the hammer, the open and close near to each other, and then a long lower handle like you'd be holding the hammer. Think of it as hammering out a bottom. It's a short-term bullish signal. All the other answers, hanging man, shooting star, and inverted hammer, are very similar to that, but they're just in different phases. An inverted hammer is the exact same, but as implied, it's turned over. So the open and close are near the lows of the day. Hanging man and shooting star are those same patterns, but they happen during an uptrend. So the market goes up, and then you have that pattern. It's called a hanging man. As always, I think the names of them are less important than the conclusions you can make with them. I'd encourage you to dig into chart school, focus on some of those candle patterns if you don't know them. So it'd be a great way to understand the short-term dynamics on a particular chart you're looking at. Let's get to our market recap. As I mentioned, the S&P closing lower really through the course of the day, opened lower and then chopped around. There's a bit of life there going into the late afternoon, but gave most of that back to close around 39.60 or so. That's down just under 1/3%. The NASDAQ down a little less, down, 0.1% on the NASDAQ composite. The NASDAQ 100, more the mega cap version of that, down 0.5%. Mid caps up, small caps up. And the reason why that is, if you look at these sectors, financials higher is going to make small caps look a lot better than they have recently when financials were weaker and small caps were at the bottom of the list. So here you have a bit of mean reversion with large caps underperforming small caps, that ratio tilting back toward small caps. And overall, that's been the trend. The VIX, by the way, is back below 20. 10-year yields a little higher. Earlier in the day, they were a lot higher, but they settled back down to close around 173. The bond price of the TLT index up a little bit. Commodities, we have commodities as a whole down, with gold prices down 1.7%, silver down 2.8%, and so forth. Cryptocurrencies overall higher, with Bitcoin really having a nice afternoon, closing around 59,000, just below there. Again, staying below that very tempting 60,000 level to see if we can get a close above there. Let's look at a chart of the S&P 500. Think about this overall trajectory. So again, I was interviewed, recently, and I'm asked about what do you think? And overall, it's that you can't be that negative when the market is this close to all-time highs, right? Overall, the trend is in good shape. I think for me, the challenge right now is less on the overall market direction overall, which at this point still remains positive. We're making higher highs and higher lows. When that changes, you will hear me tell you we have a problem. And I think for me, the level I would look at is 3,700. As long as we remain above that during this phase, I would say overall, this is more of a choppiness, recalibrating, giving, taking some profits, reevaluating before the next move higher, led by things like financials and energy, perhaps. Or this is the beginning of something more distributive. The challenge I have with the S&P chart are the bearish divergences. We see the bearish divergence on the S&P chart, lower highs and momentum as the S&P's gone higher. In recent days, we've talked a lot about the bearish divergence in semiconductors last month, the bearish divergences on financial stocks like JP Morgan more recently. Again, for me, divergences are a warning sign. Breakdowns in price, when the stock actually makes a lower high, when it makes a lower low, that's when it tells you things are really starting to get challenged and when you really need to think about the risk. We haven't seen that yet. We have seen things like semiconductors and the NASDAQ break down through their swing lows, break down through their January lows. We have not seen that from the broader averages and from most sectors. As a matter of fact, a lot of sectors actually rotating higher this week, including real estate, which we'll talk about a little later in today's show. So at this point, for me, my medium-term market timing model has been negative for about a month, since February. I don't have a problem with that, because it's telling me to basically be tapping the brakes mentally on looking for the next great thing. It's telling you expect limited upside in stocks, but there's a potential for downside, and that's where you want to think about risk. And it's all about identifying those lines in the sand. Now, when we're near all-time highs, it's the time to think about what your emergency scenario would look like, where you would maybe want to take action to exit positions, to think more cautiously. It's also worth noting, as we're looking at some of these big picture charts, a lot of things look kind of like Marathon, MRO. This is a stock within the energy sector. Obviously, it's pulled back to an ascending 50-day moving average. When we did our shifting stock segment yesterday, we had a lot of names that were also coming back to their 50-day moving average, things like Hess and others in energy, but other sectors as well. Alphabet's pulled back to its 50-day moving average, Comcast, Disney. There are a bunch of things that are sort of pulling back there. And the question is this a pause? Is this the pullback, short-term weakness within a long-term uptrend before the next leg higher? These things start to break. Something like Marathon Oil goes below $10 and starts to come back into the range from earlier in the year. Stocks like Alphabet, break down through their support levels, don't hold their 50-day, but go down through them and break $2,000 a share. I think there are really clear levels that, as long as we stay above there, things aren't that bad. But when we start breaking down through there, you have to sort of say things might be that bad, or they're worse than they have been before. I did want to check in on our main look at breadth. It's worth noting here, again, it's still pretty early, so I'm not really willing to declare this the end of the world by any means, but just in the last couple of weeks, we made a new closing high on the S&P, really close to it here this week. We did not confirm that from the New York Stock Exchange or mid caps or small caps. Pretty much the S&P breadth was the only one that has made a new high, a new closing high this week. That might be something to keep an eye on. Overall, the trends in these breadth measures are still very positive. I don't think there's anything really to worry about yet. But when you see a market going higher and it's not confirmed by breadth measures, that was one of our best tells, I think, at the February 2020 high, was the market going higher, but that's not confirmed by breadth. We haven't seen that sort of divergence yet. That also, by the way, is what concerned me back here in, going in the September high, was you had, the market going higher. The S&P was the only breadth line. All the other ones actually made lower peaks during that time. And again, that wasn't a lot of pain on a price basis, but that was the last big corrective period that we've had. So it would be interesting to see if we continue to see that evolution of higher market move, but less high, or not confirmed by the advanced decline lines, by the cumulative breadth measures. Just to finish off our review today, I just wanted to point out some of the things that are working today. You have consumer discretionary and financials 1 and 2, followed by industrials. All the other sectors actually finished in the red. The bottom of the list, you have healthcare, consumer staples, technology. When I'm asking me for charts that concern me, or not that concern me, but charts that stand out, biotechs might be one of those. Biotechs, the IBB, for example, has now made a lower high. It is now testing its 200-day moving average. This looks a lot like a Head and Shoulders top. You need to break down through the neckline, which means you have to get below some of the current levels that we're at. But having the biotech index testing its 200-day moving average is really telling. This is where it held back here in September and November. My question would be, are we able to hold that again this time? That's why that chart is on my list. We need to take a quick commercial break. We'll be back with my guest, David Auerbach. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. It's great to have you join us every weekday after the close as we look at these markets together using the power of stock charts, using data visualization to understand trends and piece apart momentum. As a reminder, we love doing our mailbag segments. It's one of the ways we can help point you in the right direction and address some of your own questions that come up in your analytical process. Anything that comes up, shoot us an email, thefinalbar@stockcharts.com, on Twitter @finalbarsctv, or on our YouTube channel. Just put a comment below the video that you're watching. We'll do another mailbag segment at the end of this week, and we'd love to answer one of your questions on the air. Also, as a reminder, the new StockCharts TV on demand is released out to all of you. It is really well done. I'm proud of our team and all the time and effort they put in to illuminate some of the great expertise of our hosts and fantastic guests that we bring through our shows. Go to stockchartstv.com to use your email and set up a free account, or we're on all the app stores. Just search for StockCharts TV on demand. I want to welcome on my guest joining us again on the show, David Auerbach. David's an institutional analyst at World Equity Group and also co-editor of the Daily REIT Beat. David, it's good to have you back.
Dave, great to be with you. Thanks for having me.
Of course. Now, when we're thinking about, REITs, I'd love to just think, when I'm looking at the 11 S&P sectors, I think a lot of people are surprised to just see real estate and the real estate sector performing pretty well, testing new highs. Does that surprise you at this point, or is that sort of what you'd expect given your knowledge of the space?
I'm not really surprised, since we're in a much different situation today than we were literally a year ago at this point. We've seen two camps out there, the work from home trade versus the return to office trade. And so you are starting to see some of these folks put on some of these riskier sector trades that were really considered out of vogue in the second and third quarters of last year. So I am not surprised to see us seeing some signs of recovery across multiple industries here.
Well, I always advise people, focus on, if you want to survive as an investor, focus on things that are working. And it's hard to deny some opportunities that are seeming to pop up. Now, you've brought two tickers with us. The first is DEA. What can you tell us about this?
So this is a really unique story. The company is called Easterly Government Properties. They own 82 properties. Of those 82, 80 are U.S. government agencies. So totaling 7.5 million square feet, you're talking about government agencies such as the FBI, the Drug Enforcement Agency, the FDA, the EPA, the IRS, the Department of Veterans Affairs, the FAA, FEMA, the Department of Transportation, the Small Business Administration. All of these government agencies are are tenants of DEA. So as a result, the government is DEA's pretty much sole tenant, which means the government is paying the rent to DEA, which means DEA is paying the shareholder dividends earned from the government.
Hmm.
Currently, DEA's dividend yield is just under 5%. They just paid a 26-cent quarterly dividend. But again, when the government is your sole tenant, do you really think the government is going to let the FBI or the Department of Veterans Affairs or a lot of these various important government agencies fail? And so you're talking about a company that's received 100% of their rent collection during COVID.
Interesting. It's a unique story in the real estate space from how you're describing it. And you can't argue with a decent yield as well. The second chart you brought was REIT, and I want to point out it's not a dollar sign REIT, which for us is the REIT index, but this is actually the ticker REIT, which is an active ETF, right?
Yes, that is correct. It is the second active REIT ETF that's come to market. This just came to market on February 25th, so it's just over a month old. It's got about $12 million in management. The reason why this is an interesting play, this takes into account the active versus passive discussion in the ETF industry. So for those that were holding passive ETFs such as VNQ or IYR, when you were going through the lows of COVID last year, chances are these portfolios were still equal weight in a lot of the troubled sectors such as hotels and offices. While REIT, the ETF here from Alps, provides more of an active position. So for those that are now wondering if we're on the work from home or return to work trade, REIT is going to take advantage of those sectors that are really popular right now, such as towers, data centers, on single family residential, and maybe a little bit more passive or a little bit more underweight on names such as like in the office sector and the hotels. But in the same breath, as we start seeing this return to office trade go back on, they may unwind that work from home trade and start putting on some of these office and hotel type trades. So it's just a very active way to play the REIT industry. It's just a new security to play it.
It's an improving chart, rolling, moving back to the upside, which is impressive. We only have about a minute left, David. And I'd love to just ask you, and I think there's been such a discussion recently about, sort of growth versus value and thinking of it as a very, I would argue, a very binary thing, right? It's sort of technology, those things are working, or it's financials or energy. How do you put real estate? How do you put that within that context? Do you bucket it in a certain way, or should investors think of it as they're balancing their own portfolios as its own thing, right? As its own asset class? How do you think of it?
I think it's a little bit of both. And it's a great
Yeah.
point that you raised, because some of the stuff that was considered growth a couple of years ago is now considered value in the
Yeah.
industry. And
Yeah.
so you have some of these nichier sectors like cannabis and infrastructure, and maybe the towers and data centers that still have some of that growth potential, while on the value side, you still can fall back on your grocery anchored retail, your apartments, your offices. So I think it's a little bit of both camps, but at the end of the day, the talking heads still suggest you should have 5 to 15% of your portfolio allocated to a real estate sector.
It's a great take, David. As always, appreciate you sharing some of your expertise, bringing some ideas and helping us make sense of things, particularly in the real estate space. David Auerbach, stay safe, be well. We'll talk to you again soon.
Thanks, Dave. Keep up the great work.
I appreciate it. It's David Auerbach. David's an institutional analyst with World Equity Group, also the co-editor of the Daily REIT Beat. And it's funny, I've enjoyed so much on this show, bringing on people like David who have great, subject matter expertise and understand the space, and helping us think about how to deal with all these levers that you can pull as an investor, right? I think particularly with real estate, some of my conversations with David have reminded me of how to think of it as as an allocation, think of it as a portion, think of the dividend component and how that relates to all the other levers you can pull. When you think about sort of diversifying your approach, think about all the different places you can focus, make sure you're looking at all the opportunities. If you don't look at something like REITs, I'd encourage you to look at all the possibilities. Let's continue on. Our next segment is the final bar mailbag. As I've mentioned to you many times, one of my favorite parts of this show is hearing from you, answering your questions, and helping to point you in the right direction. These are all questions we received in the last couple days. Let's get to it. Question number one, I love this one, by the way. Dave, you mentioned you will be taking a week off without connectivity. How will you manage your personal portfolio with no access? Also, from your time in institutional shops, how would PMs handle vacation, and what proactive steps would they take before leaving? So, at this point, I'm less concerned with my portfolio and more my two children, and making sure we, mommy and daddy, stay sane as we unplug and have screens without as not an option for a week. As we're going to the backwoods of Oregon for a week. But overall, your question is really well founded. It's funny. I often, what I learned over time is not to be afraid of taking those sorts of time off. For me, I'm more of a long term. I have a longer term perspective. I'm not trying to game things in the short term. For me, that's more color to help you understand the long-term picture. I'm more interested in following trends. So, making sure that that you have the proper perspective should allow you to take, some time off and not worry too much about the end of the world. Having said that, the second part of your question leads more to preparation. I would say, on a longer hiatus, something like a longer period of time we're going to be away, we would always have a backup plan for someone who's managing a portfolio. I have a team of people that were watching it, that knew the process well enough to make sure that the portfolio maintained what it was trying to do and that things didn't get too far away from the intention of the portfolio when a time when the PM wasn't going to be there. I would also tell you that the good news with most of us as individual investors, if that's how you describe yourself, you have a lot of ways to automate things. What I would say is, things like stops, things like risk management, things that you want to lock in and just make sure, as long as XYZ does not happen, I think the portfolio is going to be fine while I'm gone. That's what I would do. That's a time where I think automation can really add some value. So, for me, there are things I'm going to do to just make sure that, that things aren't going to completely unwind in a way that I'm not prepared for while I'm gone. I'm actually pretty comfortable unplugging and not worrying too much about it. And if I miss a week, that's going to be okay. I think psychologically, a week away from looking at the markets after many, many years of looking at the markets very closely is the toughest part. And it'll take me through probably Wednesday to not be thinking about stocks a lot. So sorry, honey, I'll try to move up that timeline. Question number 2. So you say the XLP is a value just breaking out and not overextended. I'm buying puts, et cetera, et cetera. We'll see who's right. You may absolutely. And I will be the first to admit that I am wrong plenty. I was just speaking, by the way, earlier to students at Texas A&M University. I've gone there in person and done it a number of times, but did it over Zoom this time. And what I told them is one of the slogans I heard years ago, which was, it's okay to be wrong. It's not okay to stay wrong. So I am emotionally prepared to be wrong plenty. And I think the game is accepting that and then acknowledging when you're wrong and not having your portfolio suffer when you fail to admit that your outcome was incorrect, that your positioning is incorrect. So with staples, you're absolutely right. And if we look at maybe a different chart here of the XLP, you're absolutely right. These stocks are overbought, coming out of the overbought condition. The last time they were overbought was back here in September, maybe again at the mid-November before they sort of stabilized. That is a very real possibility that the gains are in and then they kind of do it. For me, when a chart breaks out, I tend to assume that breakout has further upside until proven otherwise. So 67 is sort of that pivot point. As long as we remain above the breakout level, I would say that this breakout is still in pretty good shape. If we would break down through that, I would have to admit, you're right. This was just a quick move, and it doesn't have staying power, and I'd be more concerned about it. But overall, I think, could there be a bit of a pullback? Absolutely. I would think that's totally reasonable after a sector's had a good 1 month run, which it definitely has. Next question, have a safe vacation, and thank you. One question, yesterday the chart of XLV breaking out versus the SPY relative strength turned out to be a failure. When would a pro have turned in the towel, as I was late to abandon the XLV trend failed breakout? That gets back to my earlier quote, right? Admitting that you're wrong and getting out of it is absolutely right. I'm not sure what point in particular you're talking about on the chart, but maybe you're looking at this and seeing that it's breaking out. Maybe you're actually talking about this. That's my guess. I think you're talking about this breakout here and thinking, it's funny. It actually looks a little bit like the Staples chart, right? Where you've had a period of underperformance, turns up a little bit, overbought. This is right at the break to new highs, and that's been it. That's been the peak. I think that is a very a very real challenge with breakouts. When you buy breakouts, when you buy a chart making new highs, you are taking on the risk that it's a failed breakout. And that has happened many of times. It will happen many more times after today. And so I think it's all about managing the risk and the potential reward. The potential reward as a trend follower is breakouts persist and they continue higher. That has happened many, many times. The risk is that the breakout fails and we come down and break new lows. And so I think when the relative strength line turns back lower, that's when I would certainly be concerned about it. So for me, after the breakout, when the relative strength line makes new lows, that tells me other things are working better than this chart, and to look elsewhere. That's the line that I would be looking for there. Probably the final question. It seems like the rising dollar is playing a role here. I would love to hear how the dollar factors into your process on the final bar sometime. I have a chart. Where was I going to look at this? Maybe small versus large. I put it on one of these charts recently. I think it was in here. So we'll see if I can find it in 2 seconds. And if not, I'll show you something else. I think it was maybe not small versus large. I think it was the US dollar chart, maybe here. There we go. So this is the dollar index at the bottom, $sign USD. We use the DXY is another thing a lot of people would use. For us, $sign USD is the dollar index, and it's tracking the same thing, that dollar weighted against other currencies, and it's essentially the euro flipped upside down because the euro is a pretty big weight in the index. At the top, you were looking at the relative performance of the U.S. versus the global equity markets, the S&P over ACWI, All Country World Index. So if this is going up, that means U.S. stocks are outperforming global stocks. If this line's going down, U.S. stocks are underperforming global stocks. So if you look, the trajectory, the movement in this relative strength of U.S. versus non-U.S. or U.S. versus global essentially follows the dollar. And when the dollar is strengthening, you can see in general that this is going higher, meaning U.S. is outperforming non-U.S. When this is going down, you can see that it's underperforming. It is not 100% of the time, though. So you can see times like last August where U.S. stocks start outperforming and the dollar's going down. And I think that is the challenge I have with the dollar index. There are certain things that you can assume if the dollar is strengthening. Dollar stronger should be good for small caps, but if you look, there have been periods where small caps are doing fine and the dollar's underperforming. The dollar going higher usually means good for U.S. versus non-U.S. That's probably the one I would feel most comfortable betting on. But again, there are periods, a month at a time here, like last August, where that's not the same. Same with the end of June of last year. Dollar goes up and this relative strength continues to go down. So it is not 100% of the time. And I would caution you, anytime you have two things, it is very easy to want to oversimplify and say stronger dollar means what? And all you need to, if you assume stronger dollar, you just need to buy this bucket and it's probably going to do well. Those relationships don't happen in a vacuum. There are a lot of other things going on. And it's understanding how this dollar strength fits into the overall mosaic that we have. Having said that, stronger dollar certainly would indicate likelihood of U.S. outperforming non-U.S. That's what we've seen. We've seen emerging markets struggle, and I think the dollar strength is part of that overall theme here. We need to wrap the show, folks. Go to the 3 and 3 charts in 3 minutes. Here we go. We finished the discussion of the mailbag with a chart that looked just like this one, looking at the dollar strength. And again, the reason why this is an interesting chart is because if the dollar is stronger, I don't think of it as a guarantee that the U.S. is going to outperform, that small caps are going to do well, whatever's going to happen to gold. Like you can make assumptions, but for me, it's more about a headwind and a tailwind. The dollar going higher is more of a headwind to U.S. outperforming non-U.S. stocks. It's a headwind for large cap outperformance. And that's kind of how I would think of it. It's not on its own and there are other things going on. But looking at these guideposts, what the dollar is doing, what interest rates are doing are certainly of importance. And that's what I would be looking for there. Chart number 2, the relative strength of consumer discretionary versus consumer staples. We've seen a rotation lower on the cap weighted version. That obviously is a big weight on Amazon, which has been struggling, which is why this ratio has come down so much. You this week have seen the equal weighted ratio for the last 2 weeks come down as well. You're seeing some interesting charts in consumer staples. The question as was raised earlier is how sustainable is that? And I don't really know, but I do know I'm finding charts within consumer staples that are in pretty decent shape. And I'm finding some charts within consumer discretionary that are a little concerning. This ratio going down tells you there's more of a rotation to the defensive side of consumer. And I think that's an important theme. Finally, OXY, OXY, this is one of the a handful of energy stocks, many of them pulling back to their ascending 50-day moving averages. Again, I was talking earlier to the students of Texas A&M, very keen on energy prices. I'd be very interested to see if these stocks are able to hold their ascending 50-day moving averages. Folks, that is our show. Thanks so much for joining us every weekday. And thanks to my guest, David Auerbach, joining us today. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.